love the channel and find it useful in becoming a happy retiree. Subscribe today.
Good morning. We talked a little bit about Apple, and I think there's an analyst out there saying that the iPhone 10 is dead and they're going to cancel it. I think it's a super stretch. I think he's an analyst trying to kind of make a name for himself. I just don't see that happening. And that's part of what happened in this market where we had a really good start to the week. Up for a couple of days, and then the worry about trade and tariffs have kind of slowly eased back in the distance a bit, and markets really liked it. And we're up a bunch on Monday, Tuesday, Wednesday, and then kind of flattish on Thursday, and then wham, got hit on Friday. The market still ended up or net positive on the week, about 0.5%. But we're still in this correction mode. The S&P 500 is still down about 7% for the year. The Dow is down about 8% on the year. Apple was down 7% for the week. So there's obviously a lot happening here. And one thing we'll talk about here in this 10 o'clock hour is something called the inverted yield curve. And we'll get to that. And let me get to inverted yield curve. We've got to get to that. It's a super important piece of the equation, what markets are watching for. And you're going to hear a lot about this. So I want to kind of just explain this. The inverted yield curve, and we're coming back to the economy, the inverted yield curve sounds more complicated than it needs to be. We talked about it last week. I wanted to bring it up again on the show today. First of all, the yield curve, the term yield curve, is kind of this fancy way of saying what bonds will pay at various maturities. That's it. What do a whole string of bonds pay at various maturities? So you line up a 1-year bond, a 2, a 5, a 10, a 30-year bond, and you look at all of their yields, so what each pays in interest, along a curve in one chart. No big deal. That's all it is. The line is supposed to slope up. Think about it this way. You should get more interest the longer you tie up your money. So normally, that's the way it works. It works this way for corporate bonds, for treasury bonds, even for CDs. So a 1-year bond pays 1%, a 2-year, and this is just an example. A 1-year bond pays 1%, a 2-year bond pays 2%, a 3-year bond pays 3%, and so on. And that's in a normal world. So what does this look like when it gets out of whack is the question. Well, here's what happens in an inverted scenario. Again, a 1-year pays 1%. Now, a 2-year bond may pay 3%, while a longer-term bond, let's say a 3-year bond, only pays 2%. So 2% lesser than its shorter cousin. So this is a rare scenario when this happens. But when it does, it signals that something's wrong with the economy. If you could get more interest on a short-term bond than a long-term bond, that means that bond investors think we're going into recession. And rates at some point will ultimately go lower. Hence, longer-dated bonds reflect this by paying less in interest. And that's the scenario of an inverted yield curve. And it's an indicator that's been very accurate over the course of history. The true indicator that Wall Street watches that you'll hear about takes the yield of the 10-year Treasury minus the 2-year Treasury. That's the indicator. Normally, that's a positive number. Think 3% for the 10-year minus 1% for the 2-year. We get a positive 2. 3 minus 1 is 2. Today, the 10-year, let's say, is at 3%. And the 2-year is at 2.25. So that's only a 3.75. It's 0.75%. It's still positive. So we're not inverted yet, but it's absolutely worth watching, and we'll continue to do so. 5 out of the last 5 times it's happened, 5 out of the last 5 times we've inverted or gone negative, the U.S. economy has gone into recession. That's why it's a big deal. Usually it happens once the inversion happens, once that curve that's supposed to just gradually slope higher has a dip in it. Usually within 12 to 18 months, that's when we go into recession. A few examples. 1978, the yield curve inverted. 500 days later, we went to the 1980 recession. In 1998, the yield curve inverted. 550 days later, recession. In 1999, the yield curve inverted. 400 days later, recession. In 2005, the yield curve inverted. 700 days later, recession. So the average is a little over 530 days from the time it inverts. So usually you've got about a year and a half before a recession hits. You've got about a year and a half until a recession hits after the yield curve throws us for a loop. And oh, by the way, the stock market usually does well during that period of time, that interim period of time, that 1.5 years before we go into recession. So you've got about this, once the yield curve inverts, typically you've got about a year and a half where stocks are kind of dead man walking. They still go up on average about 12% until the recession hits. And then, of course, that's an environment where stocks do not do well once we get a real whiff of recession. And that is, my friends, the inverted yield curve. Beware of yield curve inversions. It's like an earthquake in the ocean. The tsunami doesn't happen right away, but you know it's coming. And we're going to keep our eye on it. So we've talked about a lot today. We explained why the inverted yield curve is this ominous sign. It just means that when it happens, 100% of the time, historically, we've gone into recession about a year and a half later. So when it happens, it doesn't mean that the wheels fall off the economy right away. It doesn't mean that the stock market falls out of bed right away. We actually have a fair amount of time, about a year and a half, before recessions hit. We'll see if that happens. The yield curve is not, I repeat, it is not inverted. It's still relatively normal. It's still upward sloping, but it's getting pretty flat. So the worry right now that you'll hear about is that if that goes from normal to flat to basically upside down or inverted, we've got to really pay attention to what's happening in the economy, because it means we might be rolling over. Again, hasn't happened. I think that the potential for better economic growth in the second half of 2018, I think, is certainly there. The tax cuts are just starting to kick in. In fact, the most interesting chart I've seen in the last couple of weeks, it's a chart. It's Bank of America tracks its deposits, and you can imagine how gigantic Bank of America is, and you have millions of people direct depositing their paycheck into Bank of America. What we just started to see in the last print is a spike in direct deposits. What's that spike from? Well, it's a spike of about 7% over this time over last year. Where's that coming from? It's the tax cuts. It is net tax. Your net paycheck in America is going up. You might not notice it right away because it's not a tremendous amount of money for each individual, but collectively, it's starting to move the meter. We'll see if that plays through with economic numbers. That is still yet to be seen. I think the second half of the year, we will see that.
Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.